right, so we are gonna get started, guys. But if do me a favor and just make sure that your microphones are on mute while we're talking, just so there's no background noise or feedback. And then if you have a question, you can unmute yourself and ask it, or just type it in the chat, and I'll get to it at the end of the session. Okay. So today's session, we are going to be covering the budget and the P&L statements for real estate. So with that, this class won't be a 2-hour class. We'll probably be about an hour, and then time for questions at the end, just because of the structure of the class. But we're going to get started. And so when we're talking about budgets and P&Ls, we're talking at a high level about your expenses, like your cash flow, your income, and what's outgoing, because as business owners, we need to understand what that looks like. And that's what we use our P&L for. So a P&L is a profit and loss statement. That's what P&L stands for, in case you weren't sure. And what that looks like is very simply, it's just a spreadsheet or a tracking sheet where you're going to input every month what came in and what went out of your business. Now, some people running businesses at a high level, they're going to be looking at this on a weekly basis, right? Because they want to know what their cash flow is looking like every week. And it also is going to show you where you're spending your money and allow you to figure out, are you spending it in the right places, and are you getting a return on the money that you're spending? So this is a sample of a P&L spreadsheet that I used and I share with my accountant. And as you can see down the left-hand side, it's just a list of any expenses that I use or incur in my business. So I might not have all of these monthly, but I'm tracking everything that costs me money. And then if I keep scrolling down lower, you'll see I have it broken down into categories: my car expenses, my bank account fees, my licensing expenses, and then at the bottom, I also have my income, and I have my HST that I've earned. So what I want to do here is track what's going out, what's coming in, when is the money going out, when is the money coming in, and then also what's the percentage that I'm spending versus the percentage that I'm making, right? So as a business owner, as a realtor, I also have CRA installments here, because once you've made over a certain amount of money, you have to make quarterly installments of your HST and income tax payments. So you have to make sure that you're setting that stuff aside. So if you remember, in our business plan, when you guys started coaching, we did a business plan, and I allocated 30% for your taxes for every check that you get. That's what your installments would be. So once a quarter, you could then go back and look at, okay, how much did I make in income? How much did I make in HST? And then pay that from that 30% that you've been saving. So it helps keep you on track. But this list is pretty comprehensive in regard to what it covers. So you'll notice, for example, travel expenses. So if you go on vacation or something like that, that's not covered here. This is for work travel. So for example, I went to family reunion in February, as you guys remember. I could write off a portion of my flight and a portion of my ticket and a portion of my hotel room because I was traveling for work. So that's an expense I'm allowed to write off. Sign installation, virtual tours, MPAC, buying those floor square footage reports or surveys, any of those costs. Marketing could be flyers, it could be postcards, it could be Facebook ads, which I think I actually have separated out down here. It could be your buyer guides, your seller guides, it could be your folders that you create that are branded. We can write all of that stuff off, right? So what you want to be doing, or the ideal thing for tracking your profit and loss monthly, and obviously guys, your stuff is going to look a little different than mine. So for example, Audible is something I use because I listen to a lot of audiobooks. I can write that off because it's training, it's education. Office rent, I pay office rent, so that is a cost to me that I can write off as well. So when you're creating your P&L, you can just download this one right from the resources folder. But what you want to do is go through your credit card, go through your bank statement, and figure out everything that you're spending money on that's business related, okay? You can't write off clothes, you can't write off hair or nails or groceries or any of that sort of stuff. But a lot of other stuff you can, right? Staging, agent locator if you're buying online leads. Top producer was a CRM system. We use Command now, so it doesn't cost us anything, right? Your domain websites, your GoDaddy, your Google AdWords, you can track all of that. So at the very minimum, as a business owner, what you should be doing is completing this on a monthly basis. So you'll notice that I have it broken down into months, right? So that I can see on any given month, when am I spending the most money, so I can allocate my money and budget properly so that I understand when I have to have money in the bank. Sorry, does someone have a question?
Jen, do we have it in our shared folder?
Yeah, I'm in the resources folder right now. So under resources, and then under budget and P&L, there's a sample blank sheet there that you can just download onto your computer and use for yourself.
Beautiful, thank you.
Yeah. So you just want to make, yeah.
Question. Where would our monthly fees go? Under referred office expenses or realty centers?
Sorry, yeah, this would be realty centers. So you've got to edit it for yourself, right? Like you don't work at referred, so you wouldn't have referred office expenses. But because Dylan and I shared it, I would track his expenses on here as well, right?
Okay.
So you have to, all of these categories here on the left, guys, edit the ones you don't have. If you don't pay for agent locator, don't have an agent locator category. You don't need it, right? You've got to make it your own, but you might have a different program that you use that I don't have on here. So you would add that in. And so yes, everything that's not applicable, just take out. Client gifts, that can be anything from bottles of wine to closing gifts to stuff that you provide, champagne or flowers or whatever that might look like. You can write that stuff off as well. So make sure you're tracking that. And then client lunches and dinners and events. So if you have lunch with a client for a meeting or you go out to a dinner, you can also write a portion of that off. So you want to track, okay, what are the systems I'm currently using in my business? What am I paying for? You know, what social media am I using? What are my listing expenses? Everything that you pay for that relates to your business should go in this section right here under business expenses. And the more broken down and clear and categorized it is, the better, right? And then down lower, I have my car and stuff separated out because I have a lease, and I like having seen the car expenses because they're all so broken down differently for the accountant than the business expenses. It makes it easier for them. And then believe it or not, guys, we can write off a portion of our bank account fees, our credit card interest. So you can track all of that stuff as well and write a portion of that off. And then we also have our licensing expenses. So TREB, RICO, insurance, all those sorts of things. Our CRA payments, and then our income and our HST, right? So you could get really detailed with this. And if you get really structured and you do this once a month, at the end of the year, when January rolls around, your taxes are done. You can just submit this right to your accountant and say, here's my expenses and income sheet. And once you have you got to get your T4A from the brokerage and all that, but otherwise you're ready to go. It's done. It's organized. You've already done it. And it's, an hour once a month to review your bank statement for that month and your credit card statements for that month, right? And then if you notice down the bottom, I also have house expenses. And the reason for that is because you can write off a portion of your home costs. So if you work from home or you have a home office, which most of us do to some extent, you can write off a portion of some of your stuff. And some of it is just for tracking of your cash flow, right? But our cell phones, those we can write off for business. If you own your home, you can actually write off a percentage of the mortgage, taxes, the interest paid on the property, all that sort of stuff. So make sure that, you're aware of everything you can track. And you can also review this with your accountant if you want to. And if there's things you can add on, then by all means, add them on. This is a very
again.
Yeah.
So what percentage of the mortgage and hydro and all those stuff can be attributed to home office?
I don't actually know. That's my accountant does all that. I just give him what I pay, and then he figures out what percentages they write off.
Okay. Somebody
Yeah.
had told me it was about 25%.
Pardon?
Somebody had told me that those could amount to about 25% maximum.
Yeah, it's not huge, but it's something. It all adds up, right?
Yeah,
So
it adds up.
yeah. So you still want to track it, but I don't know the exact numbers because I just fill out my spreadsheets and then I share them with my accountant, and then my accountant just does all of the filing. So he just tells me what I owe, basically.
You
Yeah.
never get a refund?
No. And when you're a sole proprietor, guys, I hate to break this to you. Once you make over probably 30, maybe 40,000, you're not getting a refund. You're going to owe money. So.
Okay.
Yeah.
Thank you.
Yeah. It's just the way, because as business owners, I mean, we can't run our business in a loss every year in order to get money back, right? Or at a balance of zero, because you're going to get audited because it's not realistic. So, unfortunately, that's why I'm such a pain in the butt, I guess, about that, putting that 30% aside, is because you are going to owe money. So don't assume that you're not. You will be mistaken and you'll get a bill and you're not going to have the money there to cover it. So this is why part of the reason we do this is so we know exactly what that's going to look like, or we have at least a good idea of what did we make versus what did we spend. But also we want to make sure we're spending our money diligently, right? We want to allow for the fact that we have these expenses, and we want to make sure as cash is coming in, we're covering our costs. We're not just taking the cash and spending it on other items and then building up and racking up debt, which is a mistake that a lot of agents make. So you should know your numbers, and you should be looking at them on at least a minimum of a monthly basis and understanding what's coming in and what's going out and what you can and can't write off and what are you paying for. So if I look at this list, it's a long enough list, but I don't have a whole ton of crazy expenses. I run a pretty lean business. So, I might have my virtual tour costs. I might have my Facebook ads. I don't even have Agent Locator anymore. I don't have Top Producer anymore. I don't have DocuSign anymore. So a lot of the stuff that we used to have to pay for as agents, we're now getting provided for free, right? My office expenses cover, the monthly $100 or $90. So that would get plugged in there, plus any extra additional costs. And then the other thing I don't actually have on here is donations, because you can also track, if you make donations, you can track that and apply that. As long as you have receipts, they'll take that into account in regard to your taxes as well, right? So that's the main explanation of what a P&L is. It's just, you're just literally tracking your money. But you want to make sure that you're tracking every category that you possibly can. Now, you don't have to use this as your method. There are tons of programs you can use. You can use QuickBooks. You can use Quicken. There's probably apps online that you can use, I'm sure. There's tons of stuff you can use. So if you don't want to manually do it, you can probably do it through one of those programs and get that information as well. So, and track it that way. That's up to you. I just do it this way because truthfully, I found this to be faster and easier than using most of those programs. And that's in my honest opinion. They just seem to make it more complicated. So that's why I've gone this route with it. Someone just had their hand up there for a second. Who was that?
That was me.
What's up?
Yeah. I noticed that you put gym. You can write off your gym expenses?
I put gym under my house expenses, I think.
Yeah.
Because I'm just tracking all my spending. So some of this stuff doesn't get written off, right?
Okay. That was my question.
Yeah, no, good question. I have it here because it was a monthly expense that I paid out, and I like to see my complete breakdown of every expense I have and every possible cost. So I track that as well. But yeah, I can't write it off, unfortunately.
Okay.
No. Yeah. Any other questions about the P&L, guys? It truthfully, it is pretty straightforward. You just have to fill it out, right? You have to dedicate the time as a part of your business. And so what a lot of people do with this is that they, this is what they use their admins for. Their admins will do this for them when you get to a certain point in your business, but you still have to be reviewing your numbers, okay?
So where do you enter the income?
So I have it on page 1. just down here at the bottom. So income and then HST. So they're separate, right? Because we got to pay the HST back, and the income is what we made before HST. So when we get our trade sheet from the office and it says our income and then it says our HST, you can plug in, okay, in January you've got one check, you would plug in your total income and plug in your total HST. And then you'd know what you paid in January.
Is the installments not the HST?
Installments, yeah. So installments is there's income and there's HST installments. So this is what your monthly income is, what you've got paid, and then your installments. You're not, if you get paid, let's say $5,000, you don't pay $5,000 in installments, right?
No, I mean like you put the taxes as installments, no?
Well, I track both. So I have like, so
Okay.
for example, this should say income and this should say HST. So when I track what my income was, I might put 5,000 here. And then maybe my HST on that was, let's say, I don't know, $800. So I know that in January, if I did just the one deal, my HST installment should be around 800. And maybe I don't get paid at all in February. Maybe I get paid again in March, and that was 500. But I pay quarterly HST installments, so I don't need to do it monthly. So I would track that and then go, okay, I know I probably need to make a payment of around $1,300 to my HST for the first quarter, right?
Oh, I see. Okay.
Make sense?
Yeah.
So the HST will be similar, but the income will look totally different, because until, what happens with the income, the way the government works is once you've made over a certain amount, they'll mail you and tell you exactly what they expect you to pay and when it's due. They'll give you an outline, right? So as long as your income is matching that, then you just make those payments, as long as you're putting the money aside to cover the cost. And then when tax season rolls around next year, you've already made your payments. So you won't owe any, you hopefully won't owe that much more money. And then if you've overpaid because they over allowed, you would then get that money back that you overpaid. Does that make sense to everybody?
Yeah.
Okay. So that's the part of the reason we track it, is so that we know, you know, we know what that looks like. If we know that the government, like if I have a great year last year and then I have an amazing year this year, the government is basing my installments on what I did last year because they're averaging it out. So I might know if I'm way ahead from last year to this year, I might kind of look at that and go, I need to put more money down than they're telling me. So I'm going to make a larger payment, right?
So how do you remit your HST?
So I remit my, make my payments. I do it online through the My CRA app website. You can sign up and register, and you can make those HST payments online. Or alternatively, the government will send you HST remittance vouchers, and you can go into the bank and pay that way.
Oh, okay. Thank you.
Income, you can pay your income tax, your installments for that. You can pay through your bank as like online banking. That's easy enough to do. But you can't do HST without having the CRA login and going through their process.
Okay.
Yeah, but you can do it online now, which is great. Makes it much easier. Okay, so going back to...
Can we just get our accountant to do it?
No, they won't make the payments for you that I know of, right? They'll tell you what your breakdown is, and they'll submit all your paperwork to the government to file your taxes and stuff, but they're not, once you filed, the government then sends you what we call an assessment that shows your breakdown and your gross and your net and what you wrote off, and then they'll mail you a breakdown of what you owe and when you, like what your balance is that you owe. So you have to pay that for the previous year, and then if you've made over 30,000, I believe it's 30,000, you also then will have to start making installments for the year that you're in. So for example, I would have my 2019 taxes. If I file my taxes, I owe, you know, let's call it $10,000 on my 2019 tax return. I pay that $10,000, but I still also have my quarter one for 2020 installments that I have to make. They're two separate things, right? Make sense, everyone?
Yep.
Evie, you got your hand up?
I do. For education, can we include the articling courses or not?
Yes, absolutely. Yeah.
Okay.
Yeah, all of your any RICO classes, any TREB classes, any classes you attend that you pay online, like what it could be any sort of education. It could be an online seminar. It could have been that you went to an in-class session for a day and it cost $100. You can include all of that and you can write off a percentage of it.
Okay, thank you.
So
No problems.
the cost for both,
Yep.
we can write it off, right?
Yep, absolutely. That's education. So you can write that off as an expense. Yeah. And your accountant will know what percentage gets written off and all that. So all we do is track our totals and then they break it down based on the percentages we're allowed to write off. So we don't need to worry about that side. We just, as long as we have an accountant, we just need to track our actual spending and our actual income, right? And the cool thing about the income, guys, is also that the office at the end of the year will give you a printout with a breakdown of your income per deal, your HST per deal, and all of your office expenses as well. So you can even just fill those out when you get those sheets in January from them. So if you don't want to track it every month, you don't have to, but it's kind of nice to track it monthly and have an idea of, if you're doing a P&L properly, you should be tracking it monthly and know, okay, this is what's coming into my account and this is what's going out of my account. And it's also going to tell you really quickly whether you're actually making money or you're not. And if you're not, then you have to adjust your P&L, adjust your expenses so that you make money, which means pull back and spend less, right? If you've got a huge profit margin, then you have the opposite. You could look at investing in something else to add to your business, which is the budget side of everything. So everyone good with the P&L? It's pretty straightforward. It's just tracking, right?
Yes,
Yeah.
thank you, Jen.
Evie, do you have another question or is that from before?
No, I'm good. No, I'm good.
Okay. All right. So I'm going to flip over to the budget stuff because this is A, more interesting, and B, it gives you an idea of how you should be allocating your money every month and every year. So if we look at this breakdown here, for example, this is from the Millionaire Real Estate Agent. That's the model. So this is the Keller Williams model. Keep in mind, guys, that these numbers are based on really high incomes and really high GCI, and they're based on American information, okay? So we do have to tweak these a little bit as Canadians, but the concept and the percentages are actually very, very similar. So when we look at this, this is just a breakdown of the cost of sales based on income. So this first column here, $6 million, is your gross commission income. That is about $180,000 in the States. Now, keep in mind, their price points are a lot lower than ours. So our $6 million is probably going to be more than $180,000. But they're saying that in order to do $180,000 worth of business, it's going to cost you $21,000 in cost of sales. Cost of sales is, your cost to list your property. So, all of your listing materials and your virtual tours and all that sort of stuff, any staging that you're providing, that's what cost of sale is, which means that your gross profit is about $159,000. And then they take off your expenses. These are your business expenses, your P&L annual operating costs, which they're running around 33%. And then your net income, that means that this is what you come home with, 55% of that 180, which is 99,000. Now, two things I want to point out here. This does not allow for taxes. This is pre-tax. And it's also based on a different model. This is a model where somebody has an administrator, so they're paying a salary as well, okay? So keep those two things in mind. But that's a breakdown of how you would look at your structure for your business. And what it shows you sometimes, and this is the interesting part, is if you take a look at this, when you're making 300,000 compared to 180,000, you're netting 62%. You're netting more because you're still a solo agent in their eyes at this level. You're doing this on your own with just probably one administrator, so your costs aren't as high, but you're netting more money, right? And then we get into, the 500,000, whereas at this point now you probably have a buyer's agent as well, which is why it's costing you 100,000. And then you get into teams, and you notice that as that grows, you net less percentage-wise for the teams, but your volume is so much higher that you make more, if that makes sense, right? So when we're looking at budgeting, you want to look at what are my percentages, because there's certain ratios that it's recommended that you're staying within in your model in order to make sure your money makes sense. So from there, we're going to take a look at this sheet, the budget overview number 2, because it's actually going to show us what those percentages are supposed to look like according to the Millionaire Real Estate Agent. Now, in Canada, we actually run our team slightly differently and we run our business slightly differently. So this is based on a team model, not an independent agent model, but we can adjust, right? So what they're saying is that the cost of acquiring the income and includes the salary and commission, your cost of sale is the cost of acquiring the income and includes the salary and commission of a listing specialist and a buyer specialist. So here's the deal. They're saying that a seller specialist, they should cost you about 5% because they're going to make about 100,000. And then on the buyer specialist, they're running at 24%, and they're going to cost you about 600,000. This is for someone making $1 million, by the way. So obviously we scaled this down. The reason that the buyer specialists are 24.8% is because you have more than one buyer specialist on a team at this point in time. So in our world, we wouldn't even have this number here, right? We would make these adjustments based on our own numbers, not these numbers, but these are the percentages. See this total cost of sales, 29.2%? That's high, right? We want to be running our cost of sales slightly less than that. We probably ideally want to be hitting around 23%. That would be the sweet spot for a single agent, and that's including your own salary, okay? So you got to keep that in mind. Now what they're showing is that a salary should run you about 12% of your income. Lead generation should be about 9.2%. Occupancy, that's rent, should be about 2%. Tech is 1.5. Your phone is 1. Office supplies are 1. Education is 1. Equipment is 1. Your car is 0.5. And they're saying on average you should be trying to keep under 30% for your business expenses. So whether you're a solo agent or you're a $1 million team is irrelevant. Your goal is that your total expenses to run your business should not cost you more than 30% of your gross income. Okay? Now, I argue...
Sorry, Jen. Can you explain more that number 1 cost of sales, like what they mean by seller specialist and buyer specialist?
So cost of sales, cost of sales according to the Millionaire Real Estate Agent are what it costs you to acquire the income that you're making. So the way they have it broken down, because as a business model with a team, my cost of sales would really just be paying my listing agent and paying my buyer agent, right? So that's what they have here. We don't have that in our business. Our cost of sales, we are the buyer agent, we are the listing agent, we are the admin, we are the janitor, we're the marketing person, we're everybody, right? So our cost of sales in our business are going to be this stuff down here, our operating expenses mainly. And then this section up here is what we pay ourselves. So cost of sale is what is it costing you to have somebody make you this money? So what's your salary? And they're recommending that it's around 30% of your income. So if you've made 100,000, you should be paying yourself about 30 of that 100 in order to have acquired that income. Does that make sense?
Kind of.
Yeah. So I think the thing is, what's confusing about this is because it has seller specialist, buyer specialist. That's just you, right? So take those out and imagine that this is buyer deals, seller deals, or just put Najim as this is what I'm paying myself. This is my salary. So when I'm working with my buyers and my sellers, on average, I'm paying myself 30% of the income from that transaction. That's my salary. That's my profit.
So, let's say it's $1 million. So they're basically saying 300,000 is what you pay yourself and the rest is expenses.
If you made $1 million, like if you grossed $1 million, yes.
Okay.
Yeah. Let's say you grossed 100,000 to make it more realistic. They're saying you'd pay yourself 30%, 30,000, right?
Okay.
Does that make sense? So this is just salaries. That's all this is. So right now, you're the only one you're paying. So your salary is just what you're making. So what most agents do is they don't pay themselves. The money comes in, it goes into the bank, they put money aside for their taxes, and most agents don't actually do that, but you should put money aside for their taxes. We pay off debt, we pay our credit cards, we pay our monthly expenses, and then whatever is left, if there is anything left, is our profit, but we're not actually tracking their profit. In this setup, you're actually paying yourself a percentage every time a check comes in. So you're saying, okay, I just got paid a check, 30% goes to me, 30% goes to my cost of my business, like my lead generation, occupancy, like these costs, right? That's 60%. 30% goes to taxes and all other overheads, and then I have a 10% profit margin. Make sense?
Yeah.
Yeah. And then that 10% profit margin you can save or invest or reinvest back into your business. That's kind of the point. Or in some cases, people donate it, right? They do what we call tithing, where they'll donate that 10% to charities or things like that. Some people, it goes towards their cost of implementing new systems into their business, or it can go towards the cost of, buying an income property. Depends on what you want to do with it. Yeah, Evie.
Sorry, I just wanted to get some clarification. So I guess an overview, 30% should be allocated for our salaries, 30% for our operating expenses, 10% profit if we're lucky, and then the additional 30%, is that what goes to the brokerage?
No, because this would be after your split. This is what you're taking home personally.
Okay.
It would be what goes to taxes.
Oh, right. Okay,
Yeah.
thank you.
Yeah, your
Forgot about-
taxes, right? Yeah. I
Okay,
know.
so we're not deducting the 30% taxes from our 30% salary. That's
No,
in addition to.
we're in addition to. So
Okay.
this is, let's say you made 100,000.
Right.
That's post office split, right? So you've already paid your office, that's their 30%, or the 19,000 or whatever. Then you have your 30% for taxes and HST. You've got 30% for your salary. You've got 30% for your business expenses. And then you've got 10% profit margin.
Got it.
Yeah.
Okay, thank you.
You're welcome. So the reason for that and the reason to structure it that way, guys, is to control your money at a much higher level. It'll protect you from getting into debt as well. It'll allocate your funds towards certain things. It'll stop you from overspending in our business, because what agents tend to do in our industry is, we do a big deal. Say you sell a $900,000 house and you get a $20,000 commission check, right? What a lot of agents do is that they'll take that 20,000 and they'll go, okay, I'll put, $3,000 into an account for taxes, which isn't enough money. And then they don't allow for their HST. And then they go, okay, I'm going to pay off, I owe 10,000 on my credit card. I'm going to pay off that full 10,000. And then I'm going to go and buy myself a new laptop because I really need one. And then I'm going to do this. And they don't have any concept of where their money is getting spent. And so what happens is they actually spend that money multiple times, because they'll go, oh yeah, I really need this new laptop, I'm going to buy it. And then they'll go, oh, you know what? I need to do this. I need to spend that. And they keep spending the same money and over again because they're not tracking it and they're actually building their debt, right?
With the cost, agent, if you buy a laptop, will it not be written off as your expenses?
Yeah, not the whole thing, but a percentage of it will be in office equipment, and you can write that off partially, yeah.
Not the whole of it?
Not the whole thing, but part of it, yeah.
Okay.
Yeah, absolutely. Anything you have to buy, a new phone, a new computer, anything you have to buy to allow you to conduct your business, track as an expense in the right category, and you'll be able to write a portion of it off, absolutely. Yeah. And then what you should do as well, actually just going back to this P&L for a minute, I don't do this because my accountant does it for me, but some accountants won't. You'll have to add in a column for the HST. So you'd have to have, say you bought a computer and you spend $1,000 under office supplies. I would put $1,000, and then I'd have to have an HST column for the HST cost as well, right? Which would be about $130 or whatever. My accountant does it for me, so I don't have to do it. But if you are doing this on your own, or your accountant won't do it, you'll have to create those columns after each thing so that it auto tallies the HST as well, okay? So going back to the budget, guys, I just want to make sure that this is clear, okay? First of all, obviously, these numbers are based on incomes much higher than what we're currently making, okay? That doesn't mean that the percentages aren't applicable. They're just applicable on a different scale, right? Now, see this number 1, salaries, that's for administrators or ISAs, and an ISA is an inside sales agent for anyone who doesn't know, so someone who makes cold calls for you. That could be salaries for, oh my gosh, a stager if you have an in-house stager, a mortgage, anybody that you pay a salary to. We don't have that. That 12% won't apply to us because we don't pay a salary to anybody. We do all the work ourselves. So we can allocate that 12% back throughout the rest of these expenses, or that's what I argue is why this total expense should probably be closer to 20% or 23%, not 30% for a solo agent, okay? So you can deduct that 12% and do what you like with it. Allocate it elsewhere or just remove it from the total. I don't think in our business, the way we run it here, I don't believe we need to run at 30% business expenses, but that's the goal. You want to keep it underneath that as much as possible. If you start to drift over that, you're cutting into your profit margin every percentage you go, right? Because that 10% becomes 9 and then 8 and then 7. And eventually like 10% will go quickly if you're overspending, which is why we need to track our expenses every month to know if we're overspending or not. And also to understand where we're spending our money. Like if you look at my list and it shows that I'm potentially, say agent locator, for example, what if I'm spending $600-700 a month to run this, right? But then I'm not getting enough business from it to cover that cost. Is that a good business decision or a bad business decision? Right? It's bad. Yeah, it's costing me money to run that system. So I have to look at that and go, should I keep this system? Am I running it at the highest level? How do I make it make me more money so that it is actually got a return on the investment, which is what we call our ROI, right? Is that a good place for me to spend my money, or do I take it out of there and then look at, okay, maybe I don't make a lot of money from Agent Locator, but maybe I'm making a lot of money off of Facebook ads. If I stop paying for Agent Locator, that's $600 a month. What if I even took half of that and put an extra $300 against my Facebook ads where I already know I'm getting return? Is that a better business decision for me? Right? Same with your database. If I'm getting tons of referrals and I can increase the level of service by taking that $600 a month and implementing a new system or putting in an additional touch or saving that $600 every month and doing a much better client appreciation event at the end of the year or better holiday gifts or whatever that looks like, is that smarter? Where is my business coming from? So, you know, when we talk about command and tracking your business and knowing where your deals come from and being really specific about that and going, okay, was this, you know, putting in their notes or their tags, were they a referral, were they a door knocking lead, were they a cold call, where do they come from? The reason we do that is so that when we look at where we're putting our money and then we look at our business and go, okay, if I pull everybody that is in my command system that's tagged as a Facebook ad lead and I look at that and I go, okay, I got 10 leads this year that converted. And that made me, I don't know, maybe 10's high. Let's go with 5. And that made me, you know, $7,000 to $10,000 because they were mostly leases, but I had one buyer, whatever that looks like. And my total annual expense for Facebook leads was a couple of $1,000s. Is that a good investment? Yeah, right? That's a good ROI. I'm getting return on that money. That $2,000 is making me 8. That's not bad. I'm okay with that, right? So that's why we need to track not only our spending and our income, but we also need to know where our business is coming from and what we're doing to generate the business and what we're doing that's not generating business. Because the stuff we're doing that's not generating business, Just get rid of it, cut it out. You're spending time, which is costing you money, and you're probably spending money, which is not making you any money. So you're just digging yourself a bigger hole, right? So all those times when we have those business conversations or questions to go, I don't know if I should do this or not. I don't know if I should spend this money. I don't know what do I invest this extra 10% in? These are the things you look at before you make that decision. But if you're not tracking them and you're not filling them out properly, then you're just guessing, which means that you're guessing with your money. You're saying, hey, this 10% that I just made, I'm going to invest it back into my business, and I'm just going to keep paying agent locator, and maybe if I paid them more money, I'll get a lead and it'll cover the cost. But by the time you keep doing that repeatedly, you're going to be so far behind, you're never going to catch up to the investment you initially made, right? Does that make sense to everybody? Okay, cool. So that's kind of one of the main reasons we need to know what's going on in our business. Hold on, someone's asking in the chat. Oh, yes. And we need to be able to track our money. So if we look at this MREA budget planning worksheet that's in our resources folder, this is a step-by-step sheet you can work through, and we'll go through it together, and it kind of gives you what to focus on and how to build your budget, okay? That's what this is. So for those of you that, I know this topic is a kind of a dry topic and it's a little bit boring, but for those of you that are motivated by it and want to get organized and want to understand your business, you can take a look at this and it'll give you an idea of kind of what you need to do in order to get your budget going and what you should be doing every month in order to review and complete your budget. So here's the things, the 3 levels key areas you want to focus on in your business are, number 1, guys, first and foremost, lead with revenue, right? You hear me say this all the time. I constantly say red light, green light, which is a millionaire real estate agent thing. If you've read the book, you know what that means. But for those of you that haven't yet, red light means every month when we analyze our accounts, if we're tight on money, if our profit margins are low, stop spending. Don't add anything new to your business. Doesn't mean you have to take anything out, but don't add anything new, right? If you want to sign up for a new program because someone has convinced you it's going to solve all your problems and make you lots of money, and it's a magic button or the magic pill that's going to change your business, which, by the way, there isn't one. The only thing that's going to change your business is working hard and implementing these systems so you understand your business properly. But that's what red light, green light is. If I look at my business and I go, oh, I got some income coming in, but you know what? And most of us are in this boat right now with COVID. It's not what I thought it was going to be. I need to make sure that I stop spending. I don't want to spend any more monthly than I've already going out. And in some cases, I might rein in. I might go, you know what? I don't really need that program. I'm not really using it at a high level. I'm going to stop spending that $50 a month and just take that back into my bank account, right? And then green light is the total opposite. When things are good and you're flush and you've got money coming in and you're running in the right percentages and your business looks good, go ahead and take that 10% and reinvest it. Add a new service to your business. Implement a new system. Buy a new CRM, whatever it is you want to do, go for it because you've got green light to go ahead because your numbers make sense. And then number 3, which is probably, in my opinion, the most obvious one, is stick to the budget, right? Sometimes people do this. In fact, a lot of the time people do this is they go, you know what? I know I shouldn't spend this 10% right now because I'm really just barely hitting my numbers. But if I buy this thing or I do this or I do that or I need new open house signs, so I should really just invest in those anyway, and they blow their budget. If you get off track on your budget, it's just going to keep you off track for the rest of the year, or you're going to have to allow for a bigger percentage payback on the following check in order to catch up to your budget, which you don't want to do. Because you should be looking at, if you know, and this is a challenge I would like everyone to do, is if you know that your goal for the year was to gross, let's say 100,000, figure out what that looks like for you. What's your budget? You know the numbers now, you have the percentages, you have the breakdowns, right? So 100,000, 30% is taxes, that's 30,000, 30% is salary, that's 30,000, 30% is cost of business, and I argue that should be actually 20%, so that's another 20,000. And then you still should have 20,000 in profit, right? So if you blow your budget, all you're doing is costing yourself that 20,000 profit, because now you have to cover those additional expenses that you spent money on. So it's just eating into your pocket. You're costing yourself money, nobody else, right? So that's why understanding the percentages in the budget makes so much sense. So leading with revenue, build your business on its own money, right? Stop putting money into it that you either don't have, like from credit, or B, that you're not making, because you're just faking it at that point. When you continually lead with expenses instead of forcing the business to generate its own income, what often comes is a total loss. So if you continue to not understand your numbers and you continue to just spend your money without understanding what the income and loss and cash flows look like, all you're doing is building more debt at the end of the day for yourself, right? I know a lot of people that have very, very big businesses that run their businesses at a high level that don't make any money, right? You'd be surprised. You'd be surprised by that. I know quite a few people, because their overheads are so high and they don't track their spending, they don't understand what their numbers look like, that they're actually just creating a total loss for themselves, even though they have a very successful business. So don't for a second think that somebody making $100,000 or $150,000 isn't actually walking home with more annually in their pocket than somebody making $300,000 or $400,000. I've seen it happen many, many times. Generate revenue in your real estate business. That will in turn fund the growth of your business, right? Spend your money properly, generate the cash flow, reinvest the cash flow into the business. Let your business pay for itself. Your business shouldn't cost you money. Red light, green light, we already talked about this. Never be concerned with how much you're actually spending as you are with the results you get by it. So when your costs creep up with no corresponding increase in results, then you have to stop and go, this isn't working. I'm going to play red light right now. So let's go back to that example of Facebook ads or agent locator ads. If I'm spending on agent locator and I'm not generating the results, and then my agent locator expenses go up and my results don't change, that's a bad financial decision. So that's when we play red light, right? That's when we stop and go, let's reevaluate here. And I'm not picking on agent locator. It's a good system. I'm just using it as an example, just so everybody knows, because I know I've referenced it a few times. Your next step, guys, stick to the budget, right? Your percentages that we talked about, they're written out for you. It's a pre-made model. Follow it. Stick to your budget. Track yourself every month and stay on track. If you stick to your budget, you'll hit your goals, because your budget should be based on your goals. So start with what your goal is for the year, and then break down your percentages based on your goal. And as long as you stay within those windows, then you'll know exactly what you're going to make for the year, and you'll know what your salary is, and you'll know what your profit margin is going to look like. Now all you have to do is do the work to make the money, right? And then obviously, guys, review the natural rhythm for budgeting. Examine your books at least once a month. Keep a monthly budget. Address it on a weekly basis. Look at your business and look for variances. Why are you off? What caused you to go off? Maybe you got a really big listing that was like $1 million, so your cost of sale went up because you spent more on your virtual tour, you did a drone video or something like that. So be it. Your cost of sale that month might go up a little bit, but what's the reason for it? And if it's a tangible reason, like, hey, I'm going to make $40,000 commission, then it's going to balance itself out. That's fine. But if it's going up and it's just because you're overspending and there's no returns on what you're spending, then that's a problem, and that's when you have to adjust, right? And then discover the budget categories, which is what we already talked about. So you have your cost of sale, which is your salaries, right? Which is, like I said before, literally what you pay yourself right now. Don't worry about buyer and seller. This is a team model, so ignore that. And then your operating expenses. What are your costs, right? What are your percentages? We already have those on that other sheet as a much more clear breakdown, so we don't need to worry about this. But this is just an example. What are your costs at each price point? If I make 150, if I make 300, if I make 600, what's that going to cost me? And every time your income goes up, you have to readjust your budget, right? To allow for the fact that your income's gone up, but so have your expenses most likely. So make sure you're still spending in the right places, all right? And then we look at this finally, the big two. Where should you be spending most of your money? Compensation, salaries, which is right now just you, and lead generation. There's a reason for that, right? If you don't have leads and you don't have business, you don't need all this other stuff. It's not necessary. If you have nobody to show a listing presentation to, you don't need a nice glossy listing presentation. So start with lead generation. Right now for us, any money you're spending realistically in your business should be going into lead gen right now. And then your salary or your income. Everything else, and obviously guys, education is a big one for us. Everything else right now doesn't matter until you start to get into cash flow and revenue. And then we have to make sure that everything's being allocated accordingly. And then review your budget model. 30% cost of sales, 30% operating expenses, 40% net income. This should not be 40% net income because they don't allow for taxes. It drives me crazy. But that's what they're claiming is net income pre-tax, 40%. Right? That's the MREA budget. It's very simple. It's laid out really cleanly. Literally all you have to do is follow it and implement it. And you'll have a budget model. And once you have that in place, then all you have to do is go back to your P&L, track your monthly numbers, and make sure that your percentages are in line with your income ratios, and you'll be fine. And you'll actually turn a profit, which means you will be more successful than most real estate agents out there who spend a ton of money and don't turn the profit that they should, because honestly, they don't even know what they're spending their money on. The amount of agents I've spoken to that if I ask them, what do you spend, where's your budget, like what's your cost of sale and where's your money going to, they just stare at me blankly. They don't actually know. They have stuff they're paying for that comes off their credit card every month and they don't even know what it is, right? So be diligent about your money and you can have an extremely successful business without making a whole ton of cash, even realistically. So your first year, your second year, you could walk away with a great profit margin. And you might not have made, you know, 200,000, 300,000, 400,000, but that's okay. You don't need to. It's how you use your money that's important. And most people don't like this stuff. They don't like talking about it. They don't like taking ownership of how they're spending their money or responsibility for it. It's very hard to do, especially if you're not money savvy. But if you have this in place and you commit to following it monthly, that's going to go a long way toward learning how to manage your money at a much higher level. And it's going to protect your cash flow, and it's going to keep you safe. You're not going to get into tax trouble. You're not going to get into any debt, because if you notice, you've allocated all of your costs per check that comes in. So you put something on your credit card, that 30% that you've allocated should go against it when your check comes in and pay it off. So you shouldn't be carrying any debt if you follow this model, which is also part of it, right? And if you are carrying debt getting started, which a lot of people are, when you get that extra 10% at the end, maybe the smart thing to do first is to pay that debt down with that 10%. And then once that's gone, then start reinvesting into your business, right?
Jen, I have a question. Would you suggest to have a separate credit card for business?
Yeah, ideally you want to have a separate credit card and probably a separate business bank account where you can put your money in. And then you can allocate it to wherever it needs to go. But for tracking purposes, yeah, I would have a separate, like I have a separate business card and all my business stuff goes on that card. And then every month I just take that statement and I plug in my numbers and I pay the balance off.
Beautiful, thank you.
Yeah, no problem. So I know that's not like earth-shattering, guys, but that's budget and P&L. It's more about implementation and understanding your percentages and your ratios than it is for anything else. So like I said, you know, we're pretty much done unless you guys have any other questions about that, or you want to review anything else that we discussed. But all of the forms and stuff that I looked at, they're all in your resources folder. So you could just take this model right here and mimic it, right? Here's your percentage ratios, and then go back over from January to now, depending on when you got your license or started, and look at your spending. Is it in line with this? Is it high? Is it low? What does it look like? And where can you make some adjustments? Or do you have a large profit margin and maybe you can invest a little bit more into your business, right? Which I know for a lot of you getting started, that's probably not realistic right now, but you never know. Evie, did you have a question? No? Okay. Any questions, guys? No?
No question. Thank you.
You're welcome. We all good? Everybody good to go? Is that kind of clear? Does that make sense to everybody?
Yeah.
Yes,
thank
it
you, Jen.
makes sense. Thank you.
Yeah.
Thank you, Jan.
You're welcome. Okay, perfect. Well, we're good to go then, guys. Happy
Okay.
Wednesday.
Bye.
Have
Thank
fun.
you.
Bye.
Bye, guys. Have a good week.
You too,
too,
hon.
hon.
Take care.
Hey, Jen, sorry, I just have one question.
Yeah, absolutely. What's up?
So when you were going through like the percentage, like there's 30% for 30% and 30% and then 40%.
Yeah.
And then you said you got to leave another 30% for taxes, right?
Yeah. Yeah.
So then you're
This is all
basically left-
pre-tax.
So basically you're left 10% for just yourself.
Well, you've paid yourself 30% salary, right?
Oh, that's what you're talking. Okay.
Yeah.
Okay.
So
I see.
30% is salaries, which is your cost of sale, right? And then
Okay, so-
30% is your operating expenses. And then 30% is your taxes. And you're left with a 10% profit, what we call a profit margin.
I see. So I thought when you said salary, that wasn't like paying ourselves. I thought you meant like paying stagers and stuff like that.
No, because right now we don't really have that, right? Like you would put in your staging as kind of more of a operating expense because you're probably not covering the whole cost of the stager, or you're just providing a consultation or whatever that looks like. Or you could include it as an operating expense because it's a cost of your business if you are paying for a stager full time. But cost of sales is salaries, and you're the only one you're paying currently, so it's just you. So you would get that 30%, and then you would, in addition, profit an extra 10% based on this model. Make sense?
Yeah, that makes sense. Thank you.
No
Thank you.
problem.
Jen, I have a quick question. Finally, I was able to get into this 8 a.m. morning. And
Yeah.
I think the reason was if you're late, you're not able to connect, I guess.
Oh, I don't know. I've logged into it like halfway through many times. It
Really?
just, yeah, I just, like I said yesterday, I just go on my phone and I scroll through to the post, and then I just hit play, and it works fine.
Yeah, the question is, the shift book they're talking and they go through, it's fantastic book. Am I able to come to the office and purchase one? I mean, just get it and they...
Yeah. If you email Hillary or call the office, just tell them you want one, and they'll put it in your mailbox or have it at the front desk for you, and you can go pick it up. Absolutely.
Is anybody in the office right now those days? Like,
Yeah, everybody is. So Hillary is in the Newmarket office Monday to Friday, 9 to 5. Debbie's in Aurora, and Huri is in Keswick.
Okay, God, great.
Yeah, we're open 9 to 5 every day, but only for our own agents.
Okay.
Yeah.
Thank
Yeah.
you.
You're welcome. Anything else, guys? Any other questions about the budget stuff or the class?
Thank you. Bye.
Bye, Innocent.